Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the lovely and tremendous investor, Anna Kelly. How you doing, Anna?
I'm doing tremendous, Michael.
That's awesome. And congratulations on overcoming your challenges in video number one. That's awesome.
Thank you. I'm excited.
Yeah, I bet you are. So one of the things that I want to talk about with you, because you and I both experience, you even more than me, right? The up close, chaotic nature, because you were at AIG of the last crisis, right? And we're going to talk about a term called counterparty risk, which, AIG had a lot of.
Yeah.
But the reason we're going to talk about this is because I proposed about 4 or 5 months ago that if any black swan was going to come up and get us, it might be China, and specifically China's property market, right? I put that out there about 4 months ago. And lo and behold, the largest property developer debtor in the world is a company called Evergrande Group in China, to the tune of $300 billion is how much debt. So their stock's down 80%. They just issued a notice they're not making interest payments. It seems to be going south, and going south fast.
Wow.
What I remember from this is my first thought was watching CNBC and having that Lehman moment when Lehman went under, and you see bankers coming out with their desks, their boxes, and all of that. What I wanted you and I, because again, we're not in China, we don't know what's going on there, that the government can come in, but I wanted to talk about what you remember from that time when Lehman went under that day, what the first couple of months or weeks were like, because it was really scary.
The first thing I remember is that I thought when they went down, oh, that's sad. But it didn't think it was going to impact me. I just thought, oh, this company's doing, going down. They must have done something wrong.
Yeah, they made bad bets. They deserve to go out.
Bad bets, right? That was kind of the news, right?
Yeah.
And then the next day it was like, okay, now Bear Stearns in trouble. Yeah. And then the next day it was, oh, AIG's in trouble. And I went, what?
Huh? What? Huh?
AIG's in trouble, right? I worked for AIG.
Yeah.
Not only did I work for AIG, but I worked in the division, the sub-company of AIG that issued the credit default swaps, which is the third-party counterparty risk. I wasn't working on those products, but I was in that division.
Sure.
And I still had absolutely no clue the level of risk that put AIG in. And so I was kind of in shock, like, what's happening? AIG might go under. I could lose my job. All of the executives were saying, we're in trouble. Mm-hmm. You might want to look for another job. Layoffs will be coming. And so that was very quick. So I was in this like shock, and I better figure out what's going on and try to understand it so I can understand if my job is at risk, if my 401k was at risk. And I quickly got educated on credit default swaps. Yeah. And I knew that we were one of the largest 2 mortgage insurance companies in the country. Mm-hmm. So not only did we have risks of the value of Lehman Brothers, because we basically insured the value of Lehman Brothers for other companies, and we had the insurance on these mortgages that were going bad. So it was a double whammy and a period of just absolute shock. And realizing that as smart as I thought I was when it came to investments and insurance and wise use of money and debt, I had no idea what was really going on in the financial sector and in the economy, and I better start learning.
Yeah, this is what I wanted, exactly where I wanted to go to begin with, because again, as I said in my daily financial news this morning, Evergrande Group is big. But in the grand scheme of things, a $300 billion company could go out of business. It's not going to impact China economy at all. But if there's counterparty risk, and then there's companies that are laddered on and they've gone 10 to 1, in some case 100 to 1, that spider web is the only thing I could think of counterparty risk. That could be a problem. And you're not going to know that counterparty risk immediately, but you'll know it soon. And it could get pretty interesting.
Especially with that much debt, because, the question is going to become what happens to those notes that are going to default? Who owns them? And who's really on the risk that they don't get paid? And what does that do to their balance sheet, right? So in the United States in 2009, it was hundreds of thousands of individual homeowners loans and property flippers loans, right? That were basically bad debt. They were not being paid. Values were going down, and they were packaged as high quality loans and sold on the secondary market and bought by, for example, mutual funds, right? And these other companies. So they were buying a series of mortgage-backed securities that they thought were A-rated and really top quality. And suddenly when the borrowers defaulted, those payments couldn't be made to the investor from the mortgage payments because they were in default. So there were tons of companies who owned a piece of these packaged mortgages, and therefore many, many companies were hit. And where it really gets bad is companies were betting on whether those loans would go bad. And so when you start to short securities and you make bets against them and they do go bad, some companies win, some companies lose. And Lehman and Bear Stearns had made some really bad bets on mortgage-backed securities. That is ultimately what tanked them, because they were on the hook very quickly to come up with money that they didn't have. And then AIG, for example, insured the values of those companies. So then when that company went down, all these other companies are like, we want to pay out of our insurance, and AIG didn't have the liquidity to pay it out. And so that's just how these things can very quickly domino and spiral, because there's so many different companies that are intertwined in these transactions. So it would be really interesting to know, and I don't know enough about China's economy to how this works, is who owns those loans and how many companies are on the hook for them. How many people are betting against those securities? Hopefully not, right?
Hopefully not,
But what institutions own the loan and how will it impact them? And could it start a domino effect of people's portfolios and institutional portfolios being really killed?
Yeah, again, I know I'm not going to pretend to know China's economy at all, but again, going back to what really kind of initiated what was a great recession. Right. Because again, it started in the financial market. It first hit financial companies, and then it started hitting other companies. And then there were layoffs and consumers were scared. It was a very scary time. I remember Teresa, I think, was in, I don't know, 5th or 6th grade. And I remember it's like the only time I ever remember her watching CNBC with us, because she's like, what's going on? What are we looking at? So if we take that to China, right, we're not calling the same kind of insurance and domino or all of that, but this, if it's because it's in the property market, there's a couple of things that could happen. One is, the faith in the Chinese real estate market could get hit. And right now, Beijing, for example, is 45-1, right? The average income in Beijing to the property price is 45-1. For example, New York, which is often cited as the highest here, is 10-1. Right. So pretty inflated. That could be, if people lose faith, that could be a problem. Right. And that could domino across other builders, right? That's what they're looking at here.
And that happened in 2009 too. So while part of it was mortgage backed, once things started cratering and people were afraid, real estate values, the demand went down. And so real estate values plummeted. And then people were really stuck because they needed to get out of houses that were worth less than what they owed on them. So that's really where I think you could have some big, ripple effects here, is if the big players can't make it work, why? And what does that mean for the underlying fundamentals of real estate, in China and where they are? So it'll be interesting to watch.
Yeah, it's happening right now. I mean, for all we know, as the Chinese government has historically done with these big players, they just come and pay everybody off and, they wipe it off the map. They're saying they're not going to do that this time. We shall see. But one of the things that I think will happen will actually help Jerome Powell, which is crazy to think about. When the world economy gets scared, and China's number 2, right? When they get scared, what do people do? They run, rush, scamper to the dollar. So the dollar is about to get stronger, which is going to mean Jerome Powell could actually have rates go lower, which drives me crazy.
Wow.
Think about that.
It's so interesting. And this is why conversations about rates, anyone that say they're definitely going up, they're definitely going down, conversations about rates are so complicated. They're impacted by more than even you and I know.
Absolutely.
Right? And that's the thing I learned in 2009 is the things that I do know, I can protect myself from, but it's the things you don't know, which there's always something that's why it's a red herring that nobody sees coming. Right. So between all of the things that are happening in the US, inflation and potential tax increases and all of that kind of stuff, that make us think mass inflation is going to be here.
Mm-hmm.
Dollar purchasing power goes down. Is it going to be offset by this Chinese, pursuit of safety?
Yeah.
They do like to come buy US real estate for sure.
Absolutely.
At much cheaper prices than what they're used to. How big this one investor's default impacts our rates, I don't know, but it's definitely something I haven't thought about.
Mm-hmm.
And I want to do a little more research about that.
Yeah, because what I'm seeing out there, and again, this is one domino. The domino could stop if the government came in and said everybody's whole, right? Then this doesn't go anywhere. But when I look at the Chinese market, and I've been reading about China for a couple of years now, Olivia's from Taiwan, so I kind of follow that a little bit. I think the dominoes that will be interesting to see if you see is it will obviously affect China's property market, then kind of Hong Kong and that general area. But then the next major economy is going to be Australia, right? There's a pretty, you think they buy a lot in the US, there's Australia's market's pretty frothy as well. So this could be, this one black swan could start a dominoes that impacts the rest. And again, if it impacts the rest of the world and we're not really there, they'll just flock to the dollar. The dollar will get stronger and rates will go down, which, okay, I guess I'll refi some 30-year rates at 1 3/4. I mean, I don't know. I'm not calling for that. I'm just saying, if the dominoes go that way, the dollar is often thought of as the cleanest dirty shirt, if you will.
Right. It'll be interesting. I'm really interested to see how it goes, because there's so many other things in the US economy that have some uncertainty that makes me think, well, there's the uncertainty there that might keep it down. But what if, the Chinese en masse start investing in the US? How does that impact prices, the dollar value, et cetera? So very interesting. Keep us abreast of what happens with that deal. And it is why, I've been wrong on interest rates before.
Oh yeah, me too.
I paid in 2009 after they went down to like 5 to reset at prime, because I thought prime couldn't go lower. Yeah. And prime went to 3 1/4, and I paid to keep it higher at like 5 1/4. I was like, that was really stupid. But I thought
it happens.
We had a lot of uncertainty, so I didn't know what was going to happen. This time I'm locking most loans for 5 years, and I don't want to lock 3 at a lower rate because I think that they're going to go up in the short term. Yeah. But I chose not to lock for 7 or 10 on a few of my commercial loans because the rate difference I'd have to lock. I'm locking in, extra fees up front rather than taking my chances and going 5 and thinking hopefully things stabilize within 5 years.
Right.
And if not, you go back to your lender and you beg them to lock again. Before they, go crazy.
Yeah, very cool. This is a lot of fun. Again, folks, there's a lot of things going on in the world that can affect the dollar, interest rates, things of that nature. It's not just, hey, gasoline's up 30%, food's up 15%, rates have to go up. The dollar is the reserve currency. And when the rest of the world is scared, they rush to the dollar.
Yes,
so it'll be very interesting. So Anna, how can people follow you?
You can find me at Facebook, Instagram, or LinkedIn at Anna, REI Mom Kelly. And if you're interested in passive investing and you're an accredited investor, you can follow me at greaterpurposecapital.com, where we offer multifamily syndications where we really invest for meaningful impact in the lives of our residents.
That is awesome. Again, greaterpurposecapital.com. Thank you, Anna.
Thank you, Michael.